Stock investors could be classified into two broad categories. You have value investors as well as growth investors. We have other investors as well, but these two broad categories are the most common. So in this video, I want to talk about how to combine value and growth investing to maximize your return. Personally, I do combine both. Essentially, I am a make money investor. I don't really box myself into any particular group. Depending on, actually, I simply go for a money making strategy. If value makes money, fine. If growth makes money, fine. If both of them combined together makes money, it's still okay with me. So value growth investing is an investment strategy that combines value and growth investment principles. It focuses on finding companies that are both undervalued and have a strong potential for growth. They are undervalued and at the same time they have growth potentials. So here is a summary of this particular kind of investing. So I want to look at the key points here, and that's the definition. So value growth investing, targets stocks that are undervalued based on, key financial metrics, and at the same time have a strong potentials for future growth. They're undervalued, they're neglected, they're ignored, but at the same time, all things being equal, with the injection of a certain catalyst, the stock will pick up and will skyrocket. Number two is principles. The principles here, have value investing. It identifies stocks trading at trading below their intrinsic values. They are undervalued. And when it comes to growth investing, this particular investing strategy focuses on companies with above average growth rate. They are growing at an average that could be considered above what's obtainable in their industries or in their sectors. Number three is the criteria. So what criteria do you really employ to identify an undervalued stocks or to identify growth potentials? So when it comes to undervalued stocks, companies trading at below intrinsic values, this is assessed using essentially, a price to earning ratio and as well as a price to book ratio. Price to earning ratio has to do with the current price of the company, divided by its earning per share. That will give you the price earning ratio of the company. And so for the book, the price to book value is the current price of the company all over the book value. That's the net asset value, the book value of the company. That will give you price to book ratios. So you have the growth potentials here incorporate companies with strong revenue turnover, sales, and the earning growth prospects. Earning here essentially is the profit divided by the share outstanding. So when the company has earning growth prospect as well as generates huge amounts as revenue, these are the criteria you take into consideration. So where value criteria meets growth prospects. So we look at the benefits of value growth strategy. It combines safety, that margin of safety from value investing with the growth potentials of growth investing. The margin of safety of value investing and the growth potentials of growth investing. Not only that, it seeks capital appreciation from both undervaluation and future growth. When you buy a stock that is essentially undervalued, all right, that particular stock all things being equal, has a potential of an outsized growth in the future. It equally provides diversification. Apart from your traditional investing, you could employ value growth investing as a means of diversifying your portfolio, mitigating against risk. When it comes to drawbacks, the disadvantages here, include it requires complex analysis and research. You have to analyze the growth aspect, you have to analyze the value aspect, so it's a bit complicated, and see how you can marry the two or balance the two before you invest. It's equally, challenging to identify suitable. How do you identify stock that is somewhat undervalued and at the same time has potential for growth? This kind of identity, this kind of mixture or combination is somewhat rare. It's not very common, but it's rare. When you come across one, don't fail to invest in it. So not only that, it has you know uh you know growth stocks can be volatile. That is a typical disadvantage. Growth stocks are known for volatility. They fluctuate a lot, kind of. So what strategies are involved in this kind of investing? Number one is a stock screening. You use metrics to find undervalued growth stocks. From a typical stock screen, you input, growth parameters, and it equally includes, value metrics. So whatever comes out of it will be your candidate stocks. It equally involves research, analyze financial health, competitive positions, as well as growth prospects. How healthy is the company? You look at its balance sheet, look at its income statement, you look at the cash flow statements, the cash flow statements, and you equally look at its competitive strengths, in relation to other companies in the sector, in that industry, and you also analyze growth potentials. So another strategy is, you involve diversified portfolio. So you include a mix of undervalued and growth stocks, undervalued stocks as well as growth stocks in a typical portfolio. Then you go ahead and then you monitor your investment regularly. You review and rebalance your portfolio as at when due and when necessary. So who is it for? Who, is this particular strategy for? It is meant for long-term investors who are seeking to a balanced approach for capital appreciation. For long-term, investors who want to balance, who are looking for a balance between, value as well as some capital appreciation. It's equally meant for experienced investors, who are comfortable with detailed financial analysis. It's not meant for it's not for new investors. Actually, it's for experienced ones that can analyze balance sheets, analyze income statement, analyze cash flow, statements critically. And it's also meant for those who are looking for diversified portfolios. They want to have a blend of value and growth strategies in a single portfolio. So this strategy is ideal for those aiming for a balanced investment approach that leverages both undervaluation as well as some growth potential. This particular strategy is for them.